Ladies and gentlemen, hello. This is Dustin Nulf with Keller Williams Realty's, the Dustin Nulf team, and Full House LLC, Pittsburgh Property Management. How y'all doing? We're going to learn how to make over 100% return on investment annually when buying real estate. I'm going to show you an example, a real-life example of a property I bought and how much I freaking love this property and how I'm getting a huge return on it and how you can do this on your own. So this is not a common example, but it's an example you can find when you really bust your butt and look for good deals, and it's an example you can find even more when the market crashes. Okay, so be aware, like, we are at the top of a market cycle, and at some point, well, let me preface this because it's 2019, it's February. We are at like the pinnacle of the market cycle right now. Stock market's getting wonky. There's all this wacky stuff going on with China and Russia and everywhere else. Like, things are looking sketchy at the moment. Okay, so we could be seeing a market shift to go in a downward market here soon, and when we do, the real estate market tends to follow that. If it's not leading, it's following. Okay, so we should have some, and when the market crashes, there are great deals to be had so long as you have the money to get them. All right, and people become desperate. Okay, they need to sell houses, and they're willing to wheel and deal and take deals that they otherwise would not take in a good market. So you can find great deals like this, and what we're going to look at is a great deal. Okay, how to earn over 100% return on investment annually off of real estate. Give us a thumbs up, subscribe down below, click the notification bell so you're notified of new videos when I post them. I'm posting 2 to 4 videos a week, so there's a lot of good content coming out there. I coach real estate sales, real estate team building, and real estate investing. If you're interested in any of my coaching sessions, there are links below. It's extremely affordable. The lowest one's at $10 a month. If you want one-on-one coaching, it's $1,000 a month, and we got a little bit in betweener in there too as well. Check those out. I got links for great books that you should read below also, and I'm gonna have a link for this microphone in there too, because a lot of people are asking me what mic I use, and it's not a super expensive mic. It looks cool, but I think it cost me like $80, and it works fantastic. So let's get rolling. All right, so here's the deal. So this property, this particular property, and I bought a couple properties like this. There's another one that I bought that is pretty close to this as far as return goes, but this is my favorite one. I love the area. I'm not going to tell you what area it is because I told other people that I liked this area years ago, and then everybody started buying there, so now I can't afford real estate there anymore. Yes, I can. All right, anyway, what I did was I met this guy, and I'm going to tell you, I'm a real estate broker now. Back then I was a real estate agent, and I was doing my job, right? I was just going out looking for listings. I was looking for properties that I could list and sell for sellers, for homeowners. And this was an expired listing, and I was strong on expireds. We're still strong on expireds. I focus on expireds every day. And this guy called me up and he said, I got your letter about the property and I still want to sell it. Can you come out and take a look at it? I said, sure. So we went out and we took a look at the property. And this is like when I first realized, like, Dustin, you should be buying these things, not selling these things. Okay? So I went out and I looked at the property with him. And I was like, man, I like this property. I like the location. I think it's really up and coming. It could be fantastic. I could see this being redeveloped in 20 years. I think it's going to be a great buy and hold. And I looked at where he was priced at. He was priced at something like $55,000. Like, and that may sound cheap to you in Pittsburgh. That was like, I mean, that was cheaper. But there was a lot of properties you could buy for 55 grand back then. And this expired, so it was overpriced, and that's what I looked at. I looked at it and I thought, man, nobody's going to pay 55 grand for it. That's why this guy couldn't sell it. And I told him that. And what I did was I gave him my 100% honest evaluation of the property, and I did not like sleazeball him or give him any sort of BS about what the property is worth. I said, listen, You probably didn't sell this because you had it listed for like $55,000 with an agent who didn't know any better, and this probably should have been listed for like $40,000. Okay, it was a duplex, but there was no full bathroom on the first floor, and it was like it just didn't make any sense, right? So if you lived on the first floor, you had to go into the basement to take a shower because there was a shower in the basement. The utilities were not split up, and you know, the house was super dated. Like, it looked like it was from like some of the stuff was from like the 1930s, like where they had not touched it. So it needed a lot of updating, basically. He had a tenant upstairs. They were paying like $450 a month. The place should have been rented out for $750 a month. It was way under rented. It was relatives of his, so he was, you know, being nice, letting them in there. He was done dealing with the property. He wasn't making any money off of it. He was pretty much break even. It was just a headache for him. So what I said was this: you had it listed for 55 grand. It's not worth that. Nobody's going to pay for that. That's why you did not sell it. Okay, so if I were to list it, I would list it for like 40 or 45, and I would expect you to sell it for like $35,000. After you pay me and after you pay the closing costs, you're only going to walk away with like 25 to 28,000 bucks. That's it. So you're not really going to walk away with a whole lot from this. So how about we do this? I'll give you $4,000 right now, and I will pay you X amount of dollars per month, and what I'm going to do is you're going to finance this. So I'm going to pay you, I think it was a 6 or 6.5% interest rate, which was way above what the banks were at. The banks were like down to like 3.5 at that time. So I could have financed this through a bank if I wanted to and got a better interest rate, but I'd rather not deal with a bank, especially on a conventional loan, because they're a pain in the butt. And for me to be able to work this out with the owner, I was able to do what we did was a land contract, and I was paying him 6 or 6.5% interest. My payment was like $320 a month or something like that total. It was pretty low, and my term I think was like 7 years. So it was going to be paid off in 7 years, or I could refinance it at any time in between there. So this guy, what he got out of it, it was a win-win situation. He got money out of it that he didn't have to spend on bills and taxes and insurance and things like that. My responsibility then was, like, I was the owner of the property. I paid the taxes, I paid the water bill, I paid the electric bill if there was one, the gas bill, I put the tenants in there, I dealt with turnovers, I dealt with evictions. Whatever was going on with the property was mine now. So he was all about it. So this is what I offered him. I offered him $4,000 down. And the purchase price was going to be 25 grand. And what I showed him was, like, if you look at that, that looks like he's getting a raw deal right now, because I told him he'd walk away with like $28,000 if he sold it for cash. The thing is, though, if you take 25, subtract the 4,000, that leaves a $21,000 principal. So the $21,000 principal over like a 7-year loan where you're paying 6%, it ends up to where he'd walk away with, I can't remember what it was, but I think it was like $32,000 total. So he'd actually walk away with interest. He'd walk away with more than if he just sold it outright, and he gets that steady income stream. So the guy's retired. He wants a steady income stream. That sounds nice, right? So it's better than investing in the stock market that just crashed. You don't know what's going to go on with that. And it's better than buying a bond where you're only going to get 3% at the moment. So he's able to get a better return. He gets consistent income over time, and he's able to pull more money out of the house than he would if he were to just sell it as is. So that's what we did. So that's my principal right there. So I got $4 grand in it right now. I ended up putting about $7,000 into it. So this was all money I was using. Like, I was taking my commission and then investing my commission into this property. So this was all cash that was my cash. It wasn't like I wasn't borrowing money. You could do this, like I have a video, I'll actually link the video below where I talk about credit card debt. You could do this with a credit card if you had a credit card with a limit high enough where you're not even spending your own money, which then when you look at your return on investment, even if you make $1 a month or $1 a year, your return on investment's infinite because you didn't spend any of your own money, right? So I ended up spending $7,000 on the rehab of this property. So we're going to do a line here, $4,000 down, $4,000 down, $7,000 in updates. Like I had to put a shower in the first floor in order to make sure that was an actual efficiency apartment. And I put a shower in, I cleaned it up a little bit, like I painted it. And then I had a plumber install a used HVAC system for that first floor so I could separate the furnaces and stuff for the 2 units. So I could separate, and I separated the electric was already separate actually, and then the gas I separated too, so the tenants would be able to pay for their own gas and electric. So I got $11,000 invested in this place. Okay? So I got $11,000 invested in this place, and I start pulling in. I'm pulling in like $450 a month on the bottom floor, and I raised the rents on the top floor. I'm pulling in $1,000 a month. So I'm grossing $12,000 a year. All right. Not too shabby. So I'm grossing $12,000 a year. I got tenants in there. Everything's going fantastic. The property value, from what I can see, because of what I did to it, now that property, like pretty much instantly, as soon as when it comes to income properties, once you have more income coming in and you've increased the updates and stuff of the property, you've increased the value of it significantly. So from what I can see, the property that I paid $25,000 for is now worth like at least $55,000 to $75,000 just because I cleaned it up and put a new tenant in it. Okay, so I increased the value there. Now, what I want to show you is how this works out over the long haul. Because if you look at this, if I'm grossing $12,000, let's break this out over here on the side. If I'm grossing $12,000, like when you look at like paying property management fees and paying insurance and taxes and mortgage and all that other sort of stuff, like you're only going to net, the easy way to calculate it is just multiply by 0.4. Okay? And that's going to give you like a good kind of worst case scenario net that you're going to have. So I'm only going to net like $4,800 a year as cash flow. And that's before the mortgage is paid actually. So that's a good kind of worst case scenario way to figure out a property real quick. If you're paying property management fees and all that sort of stuff, this is going to show you what you're going to walk away with before paying your mortgage. I'm going to clean this board up, and then we're going to look at where I'm making the rest of the money that adds up to over 100% return. All right? I'll be right back in a second. Okay, magically all this stuff appeared over here. So here's where we are. So I said this is what I was making before I was paying the debt service, basically. So before I paid the mortgage to this guy, that's what I was making. So I calculated in there roughly what the mortgage was. I actually think I was paying less than that now that I think about it, but whatever. We'll look at this as just kind of worst case scenario. So I was only cash flowing like $1,200 a year off this property. It wasn't a whole lot, right? It looks good when you look at it, like, but when it all comes down to it, it's only $1,200 a year that I was actually putting in my pocket. Now here's where you make money in real estate that a lot of people don't even think about this, and they, like, especially new investors. And I've met a lot of like investors who've been doing this for years, and they don't get this. They never even thought about it. Look, this property, I just refinanced this property. So this is what this property was valued at about a year ago when I refinanced it. So I paid $25,000 for it, and now it's worth $120,000. Okay, that's the power of appreciation. Okay, it happens quickly if you pick in the right area. So this thing's now worth, this is after repair value or after renovation value. After I re-tenanted it, cleaned it up, and it appreciated a little bit, it's worth $120,000. So we take $120,000, subtract out what I originally paid for it, and we end up with $95,000 in equity that I got in that property. Pretty good, huh? The other thing is tenants are paying down your mortgage. You're not paying the mortgage, your tenants are paying the mortgage. So long as you have tenants in there, if you buy a bad property and you can't keep tenants in there, then you're paying the mortgage. The tenants paid this mortgage down, so the tenants are paying this mortgage down. So if we were to go over the full 7-year term of this property, the tenants are going to pay that completely off. So they're paying down mortgage. That means you're getting equity out of that too. Okay? So let's take a look at how this plays out. So we take the tenant pay down, we divide it out over a 7-year term, and that means the tenants are paying down, roughly $3,000 a year if we just look at the whole term. It doesn't really amount to that if you look at the amortization. So yes, you could argue that, but whatever. I'm looking like average out over the whole term. So on average, every year, $3,000 a year. The equity that I gained due to appreciation was equal to about $13,571 per year. That's fantastic. And then the cash flow is $1,200 a year. Okay? Let's look at this. On average, I was making $17,771 a year off this property. It doesn't feel like that because I'm only seeing this on a day-to-day basis, right? So it might feel bad. Like it might not feel like I'm making money at all on the property. But over time, when you go in to sell that property or you're going to go cash it out, this is what you end up getting. Like you get a big chunk of money at the end and it's like, holy crap, I didn't realize that I was making that much money off of it. So that's what it ends up amounting to. So if you take the $17,771 and divide it by the 11 grand that we paid, as far as our down payment plus the repairs that we put in the property, that is 161.6% return on investment right there. How's that look? Does that look pretty good? So that's how it's done. That's how you can find a great deal and make a huge return on investment, and that's what you should be looking at when you're buying a property, not just the cash flow. Cash flow is nice. I would suggest if you can buy a property that's going to cash flow, buy a property that's going to cash flow. Make sure it's cash flow, but don't look at this and say, "Oh, that sucks. $12,000 or $1,200 a year. That sucks. I'm not buying this property," because you're missing out on that, right? So I hope that was helpful. Give me a like below, give me a thumbs up below, subscribe, click the notification bell, and stay tuned for more stuff. Thanks.